Hello, everyone, and welcome to the webinar on building more resilient private sector organizations through risk management. My name is Morgan Frost, and I'm a Senior Program Manager of Global Programs at the Center for International Private Enterprise, or CIPE. CIPE is the core institute of the National Endowment for Democracy and an affiliate of the U.S. Chamber of Commerce. CIPE has over 40 years of experience working with local partners such as business associations and chambers of commerce and helping them advocate for reforms essential for democracies to deliver across emerging and frontier markets. The evolving landscape of public health crises, democratic recessions, armed conflict, and natural disasters has really underscored the growing need among local private sector organizations to weather disruptions in times of uncertainty so that they may better support their communities and societies. Local private sector organizations across emerging and frontier markets in particular are facing enormous pressures to quickly adapt and evolve amid rapidly complex crises. As a report by McKinsey stated, business is not facing just a momentary inflection, but a state of volatility and long-term change that is becoming the new normal. To help local private sector organizations better prepare, adapt, and lead in times of crisis, CIPE partnered with the International Training Center of the International Labor Organization, or ITC-ILO, to jointly develop and pilot a training curriculum on fostering more resilient employer and business membership organizations. Designed for managers and board members of employer and business membership organizations, or EBMOs, the curriculum highlights best practices and strategies to support local private sector organizations in becoming more resilient. It includes perspectives from CIPE and ITC-ILO's partner networks, as well as key lessons from CIPE's podcast series titled Strengthening Resilience: Global Perspectives. In the chat, we will share the links to the 4 modules listed on screen. One important training module from the course is focused on managing risk in times of uncertainty. Unsurprisingly, this was one of the most requested topics from the course. As local private sector organizations continue to confront challenging situations, understanding how to identify, assess, and manage risk can greatly strengthen the resilience of an organization. The module covers topics such as the importance of enterprise risk management, key aspects of risk management, and finally, practical guidance and examples of how to implement risk management best practices. For today's webinar, we'll explore further how business associations and chambers of commerce in particular can better identify and manage risk, especially in times of uncertainty. And with that, I will turn it over to my colleague, Steve Rosenland, who will introduce our guest speaker.
Thank you very much, Morgan. Good morning and good day to everyone. My name is Stephen Rosenlund. I'm the Director of Association Development here at CIPE. Morgan just introduced a terrific set of resources for you, for associations on the subject of resilience and risk management, in particular, one of our latest modules developed with the ITC-ILO. I know I'll be sharing the links in the chat. I highly recommend this set of resources for you, so please check them out. We're very pleased and honored to be joined today by Gary LaBranch as our guest speaker to share some insights and thoughts with all of you about risk management for associations. And I think if it was up to Gary, I would just say, this is Gary LaBranch, CEO of RIMS. Take it away, Gary. But he has had too illustrious of a career for me not to share some more information. So Gary is a certified association executive. He's also a fellow of the American Society of Association Executives, and he is the CEO of RIMS, the Global Risk Management Society. RIMS serves more than 200,000 risk practitioners and business leaders from over 75 countries around the world through networking, professional development, certification, advocacy, and research. Gary has been an association professional for over 42 years and served as CEO for 3 other organizations and as a senior executive in numerous others. He is a member of the U.S. Chambers Association Committee of 100, treasurer of the International Federation of Risk and Insurance Management Associations, and he's on the faculty of the U.S. Chamber of Commerce Institute of Organization Management, a program of which I'm a graduate as well. Gary has published numerous books on risk management and other association management and leadership topics. He's the recipient of numerous awards recognizing his leadership in the association management profession. So without further ado, take it away, Gary. Thank you very much for your time today, and we look forward to hearing your thoughts on this important subject.
Well, thank you very much. I appreciate that lovely introduction, and welcome to everyone near and far. It's great to be with you today. I want to make sure. Can we see my slides yet? Are they here?
Yes, we can.
All right, good. Just making sure that we're all good. I commend, as the Chief Executive Officer of the Risk Management Society, I have to really commend the center, the CIPE, for putting so much emphasis on resilience and the need for a better understanding of risk management. Obviously, that's what RIMS, the Risk and Insurance Management Society, has been advocating for 75 years this year. So we're just delighted that you're focusing on risk management. Risk management is more on the minds of everyone these days. And when Morgan was describing sort of the state of the world, the state of the organizations, she was really describing what we call polycrisis. That we're there's one crisis after another and a multiple crisis on top of each other. So we all now live in this era of polycrisis, and we all need to have a better sense of what we can do about that, how we can better prepare, how we can better make a more safe, more secure, and more sustainable world. And I think that's what we're all about today, and that's certainly what RIMS is all about. And I invite you to learn more about RIMS, of course. Today, we're going to share a little bit of sort of an overview of topics around the phrase resilience. The term or the topic of this episode or this session is around how to build more resilient organizations. So what is resilience? Resilience is very simply the ability to bounce back, the ability to deal with crises, to get back, restore, recover, and return to advancing the organization's mission and serving its members and what it is supposed to be doing in the world. And so we recognize in an era of polycrisis that we're all risk managers now, that we're all in the business of anticipating, planning for, analyzing, trying to mitigate, trying to manage, if you will, risk, and then trying to recover in the face of challenges or emergencies or crises. So that's what it's all about. Resilience is the ability to bounce back and to prepare for things that are going to go bad. So let's just got a couple real quick terms. Risk is really the effect of uncertainty on objectives. That is a definition through the ISO. There are other definitions, but basically it's bad things can happen. We need to be able to think about them, be able to study them, be able to prepare for them. So they're the effect of uncertainty on objectives. We want to do something, risk happens. We need to be able to get through that risk. The risk management is the process and discipline of assessing that kind of risk or those kinds of risks and making informed decisions about how to implement measures for balancing an organization's desired levels of risk and reward. So we recognize that risk happens, that risk appears in the world, and our job as leaders of organizations is to analyze the risks that we face through the organization and then determine which ones are acceptable to us, which ones are not acceptable to us, or how much risk is acceptable to us and how much risk we cannot accept. And then how will we deal with that kind of risk? How will we retain some of that risk? How will we transfer some of that risk? How will we manage that risk? Sometimes you mitigate that risk. And then in the face of a crisis, how do you respond? So we don't have a lot of time today, but I just want to touch on some of the big contextual items, some of just to help frame all of this. There's lots of different kinds of risks. Broadly, there are dynamic risks. Those are risks that are known to us and exist, but may change over time. Financial risk. We all know that if you have money in the bank, you have a risk of losing some of that money or all of that money through theft, through fraud, through scamming, through cyber attacks, through bad business planning, through programs that don't work, that sort of thing. There's emerging risk, and those are novel risks, things that are happened only once in 1,000 years, or had never happened before. And we might think of a recent one called that COVID, a global pandemic. Well, we had heard of pandemics, but it had never really happened to us in our lifetime. So it's a novel manifestation that we had not really experienced before. And then in a larger sense, there are strategic risks. So, for example, the risk that competition will arise, or the risk that our mission becomes unimportant, or that people find other activities, business changes and other activities become more interesting or compelling than what we're offering. So more strategic ways of thinking about how trends might change the mission of the organization, or how trends might impact an industry or a sector. So there are different kinds of risks. And there are terms, all sorts of terms within risk management. So I'm going to just give you a couple for today. One is risk appetite, and that's the total exposed amount of what an organization wishes to undertake. So say, for example, we are willing to start up a new program, and we decide that we will spend X number of dollars, or X number of resources on launching that new program. We might not be able to spend much more than X plus 10%. That we can't spend too much money on it. So we do a budget. We create an amount of money that we are willing to risk to launch a new program, project, or effort. Risk tolerance is the amount of uncertainty an organization is prepared to accept. So, for example, we have so much money in the bank, or we have so much effort that we can put into something. We really can't risk. We really can't invest much more than that. We look at risk in different ways, including the ability to accept the unknown. That we will go into a new venture, maybe with a partner, and we can only do so much before we have to start to pull back. So as we think about this, when we balance these terms of risk and tolerance, or appetite and tolerance, there's a good way to articulate them, or to quantify them, is to create what's called risk appetite statements. And so I put some examples here, such as a target return of X percentage, or say 5% or 6% on our reserves or investments. Though that's a risk appetite statement. Or a very common one in associations and chambers is that we want to maintain reserves or savings of at least 6 months or 12 months equal to operating expenses. So if the budget of the organization is $100,000 a year, we want to be able to keep in the bank, in reserves, say $50,000 in operating expenses for cash flow purposes and in case something bad happens, in case programs don't work out, in case a pandemic comes along and we have to be able to operate without dues for a while. Um, other metrics that are that that really are exemplars or are statements of how much risk we're able to tolerate for the organization. For example, even as simple as we want to break even on our budget every year. We can't take much of a loss, and we probably don't have an ability to really make a lot of money, but a risk statement is we want to break even on the budget every year. So I challenge you to, when you finish this session, to think about what level of risk appetite your organization faces and how much tolerance, how tolerable are risks to you, politically, psychologically. What's the willingness of the organization to tolerate a lot of risk? Now, I'll say this, often in organizations like ours, how a CEO, how the executive director might tolerate risk may be very different from what the board might want to tolerate. So often we struggle with what the CEO and what the board will tolerate, and finding that balance, finding the right approach is an important part of managing organizations like ours. Recently, the American Society of Association Executives conducted a large-scale survey about risk and crisis management, and asked a whole series of questions of association and chamber leaders, and found some interesting data. One of the most important pieces of things that we discovered in that survey was that less than 40% of organizations, nonprofit organizations, address risk in their strategic plan. Now, that's kind of a little surprising when you go back to what Morgan said earlier. We're in the era of polycrisis, that we're all much more aware of risk management. We're much more aware of risk in general. Yet less than half of our organizations really address risk management in strategic planning. So I think we've got some work to do ahead of us. Interestingly, though, 85% of them said that they actually talk about risk management or risk decisions at their board level discussions. So risk is ever present. And that's what that to me, what was the interesting thing is we talk about, we're aware of risk. We talk about risk, we debate risk, and yet we haven't really planned for risk in our organizations. And what's even more confounding is that nearly 20% report that they actually experienced a crisis, a risk, a situation in the last 18 months. I know my organization was one of those that had a crisis in the last 18 months. We had an active shooter incident during one of our conventions. We had our conventions for 10,000 people. We had an active shooter situation that did not directly attack the convention, but was an independent thing in the city. But it affected our ability to hold the last day of the convention because it shut down the center city, and we couldn't get into or out of hotels. We couldn't run our shuttle bus routes, and we had to shelter in place at the convention center because the shooter was at large for 8 hours, and so we didn't know where the shooter was. So that's a pretty big crisis. That gets your attention as an organization, I'll tell you that. One of the other terms that you'll hear often in risk management is the term enterprise risk management. Enterprise risk management. ERM is a major subset of risk management. We'll talk a little bit more about that later. And it's sort of a comprehensive way of planning and managing for risk. And the survey said that only about 50% of organizations report having an ERM program. And I think that's another area of interest for us all. And finally, I found it interesting in the survey that 2/3 of the respondents estimated that if they had a crisis, they would only moderately their response would only be moderately effective to not effective at all. So in other words, they didn't have a lot of faith in their ability to respond to a risk crisis. Interesting. So we've got a lot of work ahead of us. Because our time is so limited today, I just wanted to touch on the basic fundamentals of risk management. What is it? How can we easily capture and summarize what it's all about? Well, this would be the slide to do that. So, what your job is as a risk manager is, number one, outline your risk environment. So, as a CEO, as you're looking at all these risks that are in front of you, chart them all out. Which ones are internal? Which ones are external? Which ones are known? Which ones are not known? To the extent possible, identify where all those risks are coming from, and identify the probability of those risks of actually impacting us. How would you rate another pandemic from hitting us? What's the probability of that? What's the probability of a fraud situation occurring in your organization? What's the probability of someone being injured or hurt at one of your organizational events? What's the probability of an employee being hurt at the office or going on a long-term leave? What's the probability of board members uh, finding some issue within the organization and deciding to resign, causing some kind of reputational risk to the organization? All of those are the process. That's all the process of identifying what are the risks that we face, and what's the probability and the impact of those potential risks. Then we have to figure out, okay, now that we have a better idea of what all the risks are that we face, how will we manage them, or how will we reduce the impact of those risks? And in some cases, can we insure against those risks? That's another way of saying, can we transfer some of our risk? So when you insure something, you're actually transferring some of that risk to a third party. You're saying, we're taking out cancellation event insurance, and we're thinking, well, it's possible that we might be hit by a hurricane or some other natural disaster, or some other thing could happen. So we want to take out some insurance so that if a hurricane hit the convention, in the city, and we could not hold the convention, that we would be paid back, at least in part, for the revenue that we would lose. And of course, if the hurricane hits and we get a payment, that we're in better shape. If the hurricane doesn't hit, then we've paid money and the insurance company wins in that case, and they're better off. But you're trying to transfer some of your risk. So basically, that's the part of managing risk, the active part of saying, what are we going to do to mitigate or reduce this risk to us? And then, of course, proactively monitoring risk, not just to see, has the risk occurred, but the elements of that risk might change, in fact. The circumstances or the environment might change. The impact or the degree to which that risk it presents itself might change over time. And so we might have to evolve our plans as needed. We might have to change our plans. We might have to get more insurance. We could come up with different ways to protect our cybersecurity infrastructure, for example. We might put more processes in place to reduce the risk of fraud or theft or embezzlement. So those are just some of the ways of thinking about risk. And a good way to approach this is to start asking questions. And these are just some of the questions you could think about. And it's a highly collaborative process. It's not something that you could really sit there and do at your desk by yourself. This involves conversation with your colleagues, with your team, with your board leaders, with your members, to get a better sense of the 360-degree view of the organization and get different perspectives on this. So, how much risks are we taking? How much risks can we afford to take? Which do we prefer to take? what do we need to take to reach our strategic goals? And then we have to weigh, which risks will we rather take, but which risks must we take to achieve our strategic goals? Where could we reduce our risks? And so go through this whole conversation with your team, because eventually you have to figure out, how can we close the gap? How do we align the needs that we have with the risks that we want to take? And then we'll find that there's a gap between what we want to do and what we can do. And we have to figure out how to bridge that gap. How do we modify our strategies? How do we modify our risks? How do we change our plans so that we can balance our risks and the mission that we're trying to achieve, as well as the things that we want to do, the opportunities. And that's one of the important parts to think about when you're thinking about risk management. It's not all about being defensive. It's not all about protection. It's also about, if you don't take risks, you won't be able to grow. So you have to think about the things that you can defend and the things that you can do to broaden your ability to serve your members and to serve your missions. Always think of risk and opportunity as two sides of the same coin. Now, where does risk come from? That's an interesting question. We can say very easily that risk comes from all around us. But it's helpful to sort of dive in and identify really the sources of risk and where they might really come from. And then it helps us to better identify what we can do about them. Now, I've listed just a few here in this slide, and there are more. But I thought I would just take the first four and give some examples of how what they are and how we can deal with them. So I'm going to start with financial risk. Every organization that has a dollar or any revenue whatsoever has some level of financial risk. So financial risk is simply any reduction or delay or loss of expected revenue or money in the bank. Suddenly you look at your bank account and you see that there's less money in the bank account than you thought you had in the bank account. Well, that's a risk. If you have money, you have risk. It could also be the depletion of your reserves or your savings account. Many organizations are lucky enough to have reserves that you then invest, and you help that helps backstop or helps protect the future of the organization. It could also be an impairment or a write down of assets. Now, say, for example, you have accounts receivable and you suddenly discover, people that are owing you money, they're not going to be able to pay it. That's a financial risk. Or if you lose investments, or if you have a property, if you own property as the organization, and you sublease part of that office space, for example, and that sublessor decides to leave, or if you lose your lease on your property, or the lease becomes more expensive, those are all financial risks. Or the inflation itself, inflation and recession for that matter. So how do you manage that risk? Well, you start by accurate budgeting, accurate annual budgeting, and also reporting, whether that's monthly reporting or quarterly reporting, accurate accounting and accurate reporting of that financial information. Cash flow analysis. How much money do you need month to month? Often you'll have a big payment for something in September, and you might have another big payment for something in March. And we have to make sure we have enough cash flow to cover those payments. That's part of the risk management process. Scenario planning. Looking at different potential scenarios and identifying if this happened, we would need this kind of money, or if this happened, this would be a problem for us. So coming up with different scenarios as sort of thought exercises, so that the board and the management team have a better understanding of what the risks are out there, and the risks are sized. They might be big in one case, and they might be smaller in a different case. Qualifying those, making better, having better knowledge about what those different scenarios might bring to us. Good example of this is back in 2018. My organization went through a scenario process in which one of the scenarios was loss of our ability to use the office due to civil unrest. And the way we wanted to mitigate that, so we thought, what if that happens? What would we do? How would we protect ourselves in that scenario? Well, we decided we needed to put everything in the cloud, and we needed to have the ability to operate by working from home. And so over the next couple of years, we put those things in place. We put out all the email and all the file systems in the cloud instead of in a physical servers. We brought in Zoom and Teams and those kinds of things and other systems so that we could indeed operate completely from home for an extended period of time. Now, we didn't think about that in terms of a pandemic. The word pandemic never showed up in our planning or in any of our scenarios. But a pandemic happened, and we were ready to go when that pandemic hit. Well, we were just lucky, not smart, but it worked out much the same. And we did that. We found that path through scenario planning. Another aspect of financial risk is making sure that if you have reserves, that you have a good investment policy statement. And I'm going to actually share one with you. If I can get it, there it is. This is an investment policy statement. It happens to be the investment policy statement of RIMS. And this is exactly what it looks like. There's a little bit more background to it, but this is what the policy statement is. And I thought I'd share this with you because this is a great example of a risk management action. So we have several $1 million in the bank that we've accumulated over 75 years. And so this is how we want to invest it. We have a 5-year time horizon. We have a finance committee that meets annually to review this policy. We utilize an outside independent investment advisor, someone who's qualified and trained. That's very important. We set a target return rate. We agree on an asset allocation so that we balance the risk that we are willing to take with the portfolio. We look at our risk measures. How stable is the cash flow? We're not worried too much about liquidity. What is our risk tolerance? Is it conservative? In our case, we want to limit the downside risk. We want to make sure we have a diversity of assets, so not too much in energy rather than and maybe some more in technology and that sort of thing. So diversifying those assets. So if one sector gets in trouble, we're not as exposed. And what's our fee structure? We put our fee structure as 1% or below as is the fee structure. So that's just an example of risk management for our investments. And you're welcome to use that or base yours on something on that similar. Other financial risks, and we see that all the time in the association world, is embezzlement of funds, especially at the chapter level. If you have subordinate units, component units, such as chapters or other aspect of the organization, units of the organization that has money, has bank accounts, those are often sources of risk, embezzlement. And then also, of course, cyber issues. And we'll talk a little bit more about that, but cybersecurity, of course, scams, that sort of thing. So how do we manage that? Using independent outside auditors, making sure your budget is budgeted accurately, financial reporting, making sure that you're complying with policies, that you have clear policies, strong cybersecurity, good insurance, training of employees, crime and insurance policy, officer and director liability, etc. Another risk is intellectual property. Many organizations, many chambers and associations publish magazines or newsletters. They may even publish books. They have logos. They have the name of their organization typically is trademarked or service marked in some way. And the risk is, of course, that others infringe or use our trademarks or our property, our intellectual property, or our service marks in some inappropriate way. And then, of course, we might infringe on the property rights of others. You utilize a photograph that someone took, and it turns out that they had the copyright for that photograph, and now they're talking about suing you. So intellectual property is an area where associations and chambers get into trouble a lot. So risk, how do you manage that risk? How do you manage that? So first of all, making sure that employees and volunteers understand what the rules are about protecting your own intellectual property and the property of others, respecting the property of others, and making sure that your organization obtains appropriate legal registrations for your own trademarks, your own copyrights, and that sort of thing. And obtain officer and director liability insurance. Cyber insurance, we could spend hours talking about cyber insurance. We all know the risks of ransomware, spear phishing attacks, Trojan horse. We were impacted by a ransomware case. It was many years ago. Someone came in and ransomwared the server on which all of our material for our upcoming convention was held. So they took all the PowerPoint presentations like this one, the videos that were going to be run, all the materials for the convention, hours before the convention was going to start. They ransomwared all of the whole machine. And our IT team was able to track that down and actually ransomware them back. So we were able to defeat the hacker. But this happens every day. We get 1 million attacks on our website every single month. And all sorts of other attacks every single day. At our last convention, from the minute we plugged in to the minute we left, there were attacks on the Wi-Fi system at the convention center. People trying to get into the convention center to then get into the phones of the 10,000 people attending the convention. So you're never too vigilant when it comes to cybersecurity. Huge risk for associations and chambers and organizations of all kinds. So making sure that you have updated software and hardware, that you have good IT training for everyone, that you actually test. We're in our team, our IT team, occasionally on a frequent basis tries to fool us. They'll send us an email to try to get us to click on it. They'll do something else that they're testing us, and then they'll do a session about, here's what we did. 3 of you clicked on this, and here's what would happen if that was a real scam or a real attack on us. Then, of course, complying with rules and regulations like GDPR or other regulations for privacy issues and for managing your own IT risk and compliance situation. And then, of course, there's always cybersecurity insurance. If you hold meetings or events, if you get people together under the name of the organization, you have lots of risk. I mentioned that our convention was impacted by an external shooting incident, had significant impacts. We had to close down the whole last afternoon and evening of our convention. And for a while, we had to lock down 10,000 people at a convention center. It was a highly stressful and significant crisis, and it could happen to any organization in any city. And then again, there's foodborne issues. People get sick, and there have been many stories of people getting ill from food that was not prepared correctly, and they served it at the banquet, and people were ill. Natural disasters. Conventions have been known to have been, hit by tornadoes or bad storms, cyclones, you name it, that either prevented them from using the meeting space or lock people down during the meeting. Protests, all those sorts of things. Bomb threats happens to conventions not infrequently. So developing comprehensive plans, how to communicate, how to evacuate the building, that has to be done for every single meeting to plan through how you're going to protect the space, how are you going to evacuate the space, how are you going to communicate to your attendees? Can you communicate to your attendees? How will you reach them? Will you reach them by an app? Will you reach them by an SMS text? How public address system? What is your plan for when you have a crisis at your meeting? What if somebody gets sick? What if somebody falls and breaks a leg? How do you handle all of those different situations that could happen? So those are just those are deep dives on just some of the sources of risk. I just wanted to share this. This goes back to that survey I mentioned. These are just the types of insurance that organizations are buying. Director and officer liability and property casualty insurance are the two number one, followed by cyber liability. But organizations utilize insurance frequently to transfer some or all of the risks that they face in these different areas. Typically, there's a deductible, which is basically a way of retaining some of that risk, that you'll pay for some of that risk. But these are good sort of list that reflects back to the list of the sources of risks, and it gives you a good idea of some of the many risks that we face in our organizations. Just real quickly, I just want to touch on a couple of terms that are out there that you'll hear about. We don't have time to go into it today, but often you'll hear the term business continuity plan. We have one. You should have one too. I highly recommend, which is simply a documented set of procedures on how the organization will respond and recover and resume operations. In particular, this is very operational thinking. It's not about strategic things. It's much more about if a fire happens, if a flood happens to the building, to your office, if the convention center gets hit by a hurricane and we can't use the convention center or the hotel for our meeting, what will we do? What's our contingency plan? How can we get back up and operating? So it's a sort of a subset of risk management, but I wanted to make sure you understood, and it's different from a whole risk management program. Business continuity planning is pretty simple. It follows many of the same elements that you assess the risk, you analyze the risk, you come up with strategies, procedures, and then you test and you train, etc. Another term, and we touched on it earlier, is enterprise risk management, or ERM. We at RIMS do a whole 2-day conference dedicated to ERM every year. ERM is a much more comprehensive, much more strategic way of thinking about risk. In ERM planning, the organization develops what's called a risk register. And a risk register, in the simplest terms, is a list of all the most significant risks that an organization might face, and then an assessment of the impact and the probability of each of those risks, and then a good description of what your plans are, what your mitigation strategy is for each one of them, and then who's responsible for monitoring those risks and on what time frame. Is it annually? Is it semi-annually? Is it every 5 years? What's the risk tendency here? What's the risk and analysis time frame? And then the whole policy around how is the board and how is management going to review each of these risks and report back, so the organization is constantly thinking about this at a strategic level, so that we have an interrelated, comprehensive approach to risk. Some great books out there on enterprise risk management, so I highly recommend you look into that. And I think it's addressed in one of the online courses that you have available to you. Now, who's responsible for risk? Who owns risk in your organization? It's real easy to say the CEO, but that's not enough. The board of directors needs to be involved with this. Key people on your management team, including your IT person, HR, general counsel, whether you have an outside general counsel or an inside general counsel, your legal advisor, and then of course program and product managers, people that are responsible for membership, people that are responsible for educational programs, whoever, they all need to be part of this approach, including your independent outside auditors. So it's really a team approach. Uh, risk impacts every aspect of the organization. So when you think about this, think about it in this way. That the organization needs to conduct a careful, comprehensive, and transparent discussion about risk. Having the CEO sit at his or her desk and think about risk and writing a few things down and putting that in the desk drawer or in the computer file, that is not enough. It really needs to be a thoughtful, deep, comprehensive conversation with the key leaders in the organization. And it's very important that the board and the staff are aligned about their understanding of risks and agree on how much risk they're willing to take as an organization and what we'll do as an organization to mitigate or manage or ensure the remainder of our risk. So why do all of this? Because risk management helps to ensure the continuity of the organization and its ability to achieve its mission and serve its stakeholders, its members, its companies, its community. Risk management is the process and the discipline that enables an organization to be sustainable, to achieve its mission, to do what it's supposed to do. So how do you get started? Number one, it all begins with senior leadership, with the senior executives, the CEO, the executive director, executive secretary, whatever the title might be, and senior board leadership. They have to set the tone that says, this is important to us, and they set the way forward for the entire organization. And then you begin by identifying what are your risks, and then thinking through some of the scenarios. What could happen if we did this? What could happen if we did that? If this happened, what would happen? And then, if you need to depend on vendors, your independent auditor, your legal counsel, your IT people, if you have outside IT people, that would be important too as well. Also, you can engage outside experts. There are consultants out there. There are insurance agencies that can help you. Lots of people can help you get started in risk management. So I'll just leave this slide. It will be part of the slide deck, but just, it all begins with identification, then analysis, evaluation, and then plan. Planning to manage your risk to ensure, control, avoid, change, mitigate those risks in some way. The important thing is to keep in mind that this is an ongoing process. It's not something you just do once a year or once every 2 years. Risk management is an ongoing process. I'd like to leave you with some resources and my organization's website, which is www.rims.org. There's a special section called that's rims.org/active shooter. And there'll be all sorts of resources that including some of the after action reports from the incident at our convention last year, and as well as a documentary video that will tell you about some of the things that we've done since then to make our convention more safe and more secure. And I think they'll put this in the chat. I recently helped co-author a publication from the American Society of Association Executives called The Association's Guide to Risk and Crisis Management, and that's available free of charge. And it's a great comprehensive digital book that I recommend for you to read. So thinking of risk management as a process, trying to identify, analyze, evaluate, and create plans is all about understanding what your risks are and agreeing as to how much risks you are willing to tolerate and how you're going to manage or mitigate the remaining risks in front of you. So happy to take any questions, and I think I'll turn it back over to Steve to moderate, right?
Gary, thank you very much for the amazing insights and all the wisdom you've shared. I mean, just an incredible overview in a very condensed amount of time here. Let's do a lightning round of questions. I'll exercise moderator's privilege and ask the first one, which I think is related to a question we just got in the chat as well. And I'm wondering, what would you say to a leader of a small staff association, small budget association in a frontier market? This is the predominant sort of form or model of association in CIPE's global partner network. Who might say, well, I don't know if this is for us, or to whom this might feel overwhelming. What can small associations do to enhance risk management capabilities that are, that would be cost effective? And we got a question from Christopher in the chat, which is this applicable to social enterprises? And he's working on a development framework for a newly created social enterprise association of Mongolia.
Wow. So some of the participants today, I'm sure, face some very interesting challenges, and I wish you all the best. I really do. I'm very proud of what you do, and I'm grateful that you're taking time to participate today. You know, you start where you are and you do what you can do with what you have. You can't start in a place like my organization is, but if you have a budget, if you have money in the bank, even if you're writing small checks, you want to make sure that that money is safe. So at the very least, you want to make sure that you have good financial controls, that more than one person is approving the expenditure of those funds, because that's where most fraud and embezzlement happens in any size organization. And it happens in very small volunteer-run organizations here in the United States and other places all the time. People will steal, very small amounts of money for the thrill of it, or because they have a need for it. But protecting the smallest assets is just as important as protecting the biggest assets. So start there. Then there's the issue of cybersecurity. If you have a website, you've got to think about what is the simple protections of that website or email system. Because if you get a bad actor, someone wants to, do some bad things, they get into your email system and they can do all sorts of damage. So just protecting the basics of your bank account and your email system is a good place to start.
Thank you. Please, anyone raise your hand if you have a question or put it in the chat. But that's a great insight, I think. I mean, all the more important for a small association, because any one of these risks is enough to bankrupt or sink a small association. We've seen it, not in the US, we've seen it in every context.
And then there's the issue of what we call reputational risk, right? So if you're a small social service, social entrepreneur organization, and you're bringing really exciting new ideas to a country, you're trying to foster private sector enterprise, having a embezzlement, having a fraud, that is going to shake the confidence of the business community. It's going to shake the confidence of the government. And it's going to take you a while to rebuild that confidence. So all the more to have a good, solid risk management plan.
Yeah, absolutely. Absolutely. Other questions? We have 4 minutes left. We're going to try to be faithful to that. I see a question, a Q&A. Given the differing risk appetite and tolerance between the actors within an organization, what are some strategies to get those stakeholders on the same page? I thought that was a really key thing you shared up front, Gary, that sometimes the CEO has a different tolerance than the members of the board. How do you deal with that?
Yeah. Well, first of all, I applaud the questioner using the phrases from the session today. So risk tolerance and appetite. I feel great that you just use those. I personally, and I've been there. I've done that. I've had this issue where I've been both as CEO wanting to take more risks and than my board, and also not wanting to take as much risk as my board. I think a lot of it, is conversation. Talking things through. In our kind of business, it's a collaborative business. You can, as CEO, you can pound the table all you want, demand, but if the volunteers don't want to go along with you, they're not going to go along with you. So having conversations, I think, is very, very important, and having good analysis. Putting the dollars and cents on what the risks really mean. What does it mean in dollars and cents if we have a venture to create a new program? How much can if we lost $100, we would be okay. But if we lost $1,000, that we would go bankrupt. Being very clear and very honest about what the stakes are, what the real risks are, and having real conversations. And sometimes those conversations are uncomfortable. They're uncomfortable because you don't want them to be real, or you're afraid of the answer. But we do no good if we lie to ourselves. So we have to be radically truthful when it comes to risks. We have to be radically truthful. What is the truth? What are the numbers? What are the challenges? What are the opportunities in very stark detail, and have some chats about that.
Radically truthful. I like that. Gary, we have one more question, and we'll put that to you, and then I think we'll get ready to close out. It's how do we ensure that all employees are aware of and trained in our risk management policies and procedures? And what mechanisms are in place to encourage reporting of potential risks or incidents? You can have the best policies in the world, but if the employees aren't on board, I guess they're not worth a whole lot.
Yeah, and that's absolutely true. Many organizations find they have lots of policies to help manage risk, and they're in a nice notebook, or they're in an electronic file somewhere, and no one has seen them since they were put on the shelf. So you can do training, obviously, is the simple answer, but the mechanics of that. My recommendation is always to pick one. Just take one policy or one risk management aspect and talk about it, at the next staff meeting. For example, just want to remind everyone that we have a process. If you need to purchase something for the chamber, for the organization, this is the form that you use, or this is the process that you go through, or that we remind everyone on staff once a year that here's the fire extinguisher in the office, or this is the escape route, this is the fire evacuation route. In the case of emergency, this is the number you call if someone has a heart attack. Those are the simple things. When we plan our convention, when we're on site at the hotel or the space, we walk the staff around the event space, and we point out, here's the fire extinguisher, there's the exit, here's the defibrillator. This is where the ambulance would come in. Making things real to people, showing and telling, and helping them to experience it, and giving them the opportunity to ask questions and see for themselves. That's makes it easier to learn, and easier to retain, and then easier to do when the crisis hits.
All right. Well, Gary LaBranch, that covers it for today. Thank you so much for your insights, your expertise. Thank you to all the participants for your time, and I'll send it back to Morgan to close us out.
Thank you so much, Steve and Gary. Thank you for that really thoughtful presentation. Just want to thank everyone for joining today's webinar. We hope you thought it was insightful in terms of risk management. I would just encourage you to take a look at the resources that we mentioned in the webinar. They are also in the chat, but we'd love to stay in touch further. And thank you, everyone. Have a nice day.
Thank you.